Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us as we wrap up the day and the week. What a week it has been too. Fairly exhausting you would think, but look, it looks as though we're going to finish higher for the week. Marginally higher on the day, just hanging on in the green it would seem. But for the week, looks as though we're going to finish up around about 0.5% higher. Let's get to the themes of the day. Wild week, wasn't it just? Courtesy of one Donald J. Trump and his Greenland play, which threatened to upend markets again, but it didn't. Perhaps we're just a little wiser as to what his playbook is. Tech support. Yeah, obviously tech's been under quite a bit of pressure since the beginning of the year. It's been resources that's done the heavy lifting here, but certainly locally, also internationally, we saw that on Wall Street. Now that comes ahead of key earnings reports from some of those large or those mega cap tech stocks next week. And inflation anticipation, this is the final read on inflation. We get the quarterly number before the RBA meets early in February. That comes off the back of that very surprising jobs numbers yesterday, which has firm support for a possible rate hike in February. Well, let's get to the sectors that have moved today and get across overall movement. I mentioned tech there, so that has finished in the green, led by Xero, NextDC, TechnologyOne, all doing well, along with Zip. Elsewhere, gold. Oh, hasn't that been shining? Another record. It is approaching 5,000 US dollars an ounce. That's more than 7,200 Aussie dollars. And yeah, we did see another record overnight, boosting the gold miners, both big and small there. That was after a fairly major sell-off we saw in the previous session. Elsewhere, consumer discretionary, and mostly in the red there, apart from Lavisa. Let's get to the corporate stories of the day. Life360, certainly the outstanding stock, up almost 28%, says it's added a record 4.2 million monthly users over the December quarter, taking its total user base to nearly 96 million globally as it seeks to monetize that hefty base further, upgrading its outlook. Guzman and Gomez had signed an exclusive delivery partnership with Uber Eats. Aluminium company Alcoa posting an increase in its revenue, but has warned of lower shipments this year. Capstone Copper saying operations at its Mantoverde mine in Chile has been disrupted, and supply network. It has had upbeat half-year results and an interim dividend 36 cents a share, but actually its shares have come off in more recent times there. So let's get to our stock of the day. No surprise, we did cover Life360, given its upgrade. Mind you, putting it in context, it has been subject of some heavy selling over the past 6 months. Well, let's hear from our experts, Adam Dawes from Shaw & Partners and Junbei Liu from 10Cap.
Look, they're pretty staggering numbers. Revenue up 32%, and then EBITDA and their margins around 19%. So, you know, great business, really, really good. And the monthly active users, as you say, 96 million. That represents the highest fourth quarter monthly additions in the company's history. So again, breaking records. They did say that their paying circles reached 2.8 million in the quarter, and for the full year is going to be around about 576,000, representing the highest annual net adds on record also.
You know, it hasn't really gone back up that much. It has been sold off a lot on the fear of slowdown. Third quarter was a little bit slow and now sort of re-accelerated. And also there was a bit of rumor, people worry about this, they need to spend a lot of money on marketing to drive the top line. It seems like that has alleviated the concern as well. Combined with that, there was some short seller report or short seller recommendation in UK sort of caused all that sell-off. You know, it is one of the highest growth companies, you know, here in Australia.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring, or drawing down, The right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN, retirement income done differently.
Joining us is Shane Oliver, Chief Economist and Head of Investment Strategy at AMP. Shane, welcome. Good to catch up with you for what a wild week it has been. Of course, dominated by President Trump, his play for Greenland. Do you feel as though perhaps markets have a firmer grip on the Trump playbook?
Probably not, but
Right.
I think markets are becoming a bit cynical about it. By that I mean that the fall in markets, while severe, wasn't anywhere near as severe as it was back in April. And as soon as Trump comes out with these things, people start talking about taco, and that's what happens. That's what happened in the end. So in that sense, markets are becoming a little bit cynical about Trump, knowing that he doesn't want to see things go too far, knowing that he will back down, knowing the way he negotiates. So in that sense, it's good. On the other hand, it just means Trump might go further. And of course, he just keeps doing these things because he knows that it puts him in the headlines and everyone pays attention to it. But it's an unfortunate reality of the world we live in. And the other bigger issue is, even though you can say, well, we had that fall and now we've recovered, but each time Trump does one of these things, it sort of chips away at the, I guess, the architecture of the global economic system, the so-called rules-based order that we were sort of living through in the post-World War II period. It chips away at faith in the US and trust between US allies and the US. And it sort of leaves, I guess, a sour taste out there. And in that sense, it's hard to believe this doesn't have a long-term impact. The uncertainty around tariffs, whether they're going to apply or not, what level they will be, what he's going to do to the Fed, who's he going to pick on next. Maybe it will be Iceland. When he was talking about Iceland, then maybe it's a sign of things to come. So all of that sort of just adds to uncertainty and basically leaves us in a world that's not as clear as it was prior to Trump coming along, unfortunately. And obviously, it's hard to say that it doesn't have some impact, albeit at the margin. And of course, right here, right now, things are still being offset by good profit growth in the US, the AI story, all those sorts of things. But longer term, it's hard to say that this doesn't have some impact in dampening economic growth globally and causing investors to have this ongoing effect of losing faith in the US.
Well, nonetheless, we did see equities rise. In fact, locally, it looks as though we're up around 0.5% for the week. Interesting to see the performance of asset classes, of course, Shane, dominated by the precious metals at the moment.
That's right. I think investors sort of are saying, it's interesting to see that what happened last week, the Fed worries, gold went up, and as soon as those Fed worries receded a little bit, not much, they receded a little bit, gold kept going. And likewise this week, gold went up on the worries about Greenland and what it means for Europe and the US. And then, of course, there was some sort of taco back down. And, of course, gold kept going along with silver on that chart there. Silver is obviously the one that stands out at present, but you've got to bear in mind that the base is only 1 year ago. If you go back further, gold's had a better ride than silver has. But obviously investors are saying, OK, yeah, we can go back out there and buy some shares, but by the same token, we want a bit of gold or silver or some protection in there as well. And that's obviously keeping that trade alive and well. At the same time, that when you think about it, if this is a sell America trade, US shares did underperform last year, underperformed European assets, underperformed Japan and so on. If that story remains, that negative US story, then it means downwards pressure on the US dollar, which of course also reinforces upwards pressure on gold and silver. I would say though, you've got to be careful here that gold and silver are getting ahead of themselves again. They are a bit technically overbought, and so it wouldn't surprise to have a correction. But I think the broad trend remains up as Trump continues to try and fill the space and causes volatility.
Now, Shane, of course, the other focus here locally is what the RBA is likely to do next. Now, bets that they're actually going to increase rates perhaps as soon as next month certainly rose post those jobs numbers. What did you make of them?
Oh, look, I was surprised by them. Well, I was surprised in the sense that they weren't our forecasts, so we got it wrong. That said, I am conscious that December and January can be quite volatile months, so I guess you've got to allow that it can be quite volatile around this time of year. But if you look at that chart there, you could argue there's still a gradual uptrend in unemployment, 2 steps up, 1 step back sort of thing. It's a very gradual one. But the other thing to note is the downtrend in the annual rate of growth in hours worked and employment. That downtrend remains in place. And so it just seems a bit odd that of the 65,000 jobs created in December, the bulk of them came from young workers. That seems a bit unusual and suggests some sort of seasonal adjustment problem associated with people leaving school and universities at the end of the year. So time will tell on that one, but I think it does make sense to wait for another month or two to see how those numbers settle down. And the RBA has in the past said that they will look through volatility in the short term in the jobs numbers. And the other chart that strikes me is that one there you put up, which shows various measures of job vacancies. Obviously, the ABS one is still quite strong, but when you look at the others, ANZ, the one called online job ads, and of course, SEEK down the bottom there, they're all softish. They're sort of running around or below levels seen back around 2017, 18, pre-pandemic, in other words, and that's warning that maybe jobs growth will start to slow down, just as it was up until the December numbers came out. They were slowing down, so that's a sign that jobs growth probably is not going to stay as strong as it was in the month of December.
And so on that basis, Shane, what's your latest thing there in AMP in regards to your rates forecast?
Well, our forecast is still on hold,
Yep.
But we're feeling a little less confident about it. We felt a bit more confident about it after the inflation numbers came out for the month of November. The jobs numbers reversed that confidence a little bit. The money market, of course, is saying something like 56% chance when I last looked, or hovering around 60% chance of a hike in 2 weeks' time. And they're talking about 2 hikes. The money market's talking about 2 hikes this year. I think that's a bit over the top. So our base case is the RBA will look through the jobs numbers, and then when the inflation numbers come out on Wednesday, hopefully they'll come out in line with our forecast for a 0.8% rise in the trim mean, which means that the trim mean goes to about 3.2% on an annual basis, but at least in the quarter it steps down from 1% in the September quarter, 0.8% in the December quarter. If that's the case, it will be in line with the Reserve Bank's forecast from back in November. They won't have to change their forecast that much, if at all, and they'll probably preserve the view that inflation will go back to the midpoint of the target over the next 12, 18 months. So if that occurs, then I think they'll leave rates on hold. If alternatively, trim mean inflation comes in at 0.9 or, God forbid, 1%, 1.1%, then odds are the RBA will probably be under a lot of pressure to hike. Obviously, the higher the number, the more the pressure. I think the problem with the jobs numbers is that if the jobs numbers were soft, they would have a bit of leeway if the inflation number for trim mean was 0.9 in the grey zone, in other words. If it's now the jobs numbers have been strong, it sort of adds to the risk that if we get a 0.9, i.e. just above RBA forecast, then it adds to the risk they may hike. So yes, we are feeling fairly nervous about it, but ultimately it will be those inflation numbers next Wednesday which will decide what the RBA does here. But I just sort of think it's better to, on the RBA's part, sort of wait a little bit longer, let things settle down. And in other countries, there was a chart in my weekly I put out, other countries have also seen a similar rise in inflation through the second half of last year, and then they've seen inflation turn back down again. Europe has been the exception to that. It's just stayed low in Europe. But elsewhere, you have seen a bit of a bounce, and it comes back down. And I think the RBA would therefore be better off just pausing on rates rather than jumping into a hike at this point.
Well, Shane, it would seem there's a lot to worry about in the world at the moment. Perhaps that's leading to cumulative sadness across the globe. And I see you pointed out that this could be reflected in music at the moment, maybe music melancholy, if you like.
Yeah.
What have you found?
Well, I'm trying to explain why my Spotify listening age was 77. But the evidence suggests, there was a study a couple of years ago out of university. There was another study which I saw in the Economist magazine, and someone tweeted it, I think, or it was out there somewhere, from something called Music Match, where the end of the music word is an X. And it showed that there's been a rise in songs, referring to melancholy, despair, angst, heartbreak, and so on. On average, the rise over the last 25 years in songs expressing those sorts of emotions has been 10 to 20 basis points or percentage points, to the point that one of those components is actually dominating now, that you've got more songs talking about heartbreak than good outcomes in terms of love. But I kind of think that it is harder these days to find a happy song, both in terms of the melody and the, they're out there, they're certainly out there, but not as much as they used to be, which I think is partly why I'm sort of stuck in 1969 or something, listening to the Turtles singing Happy Together, or Frankie Valli in the Four Seasons singing Can't Take My Eyes Off You. I mean, I love those happy songs. I often find when I get them in my head, and you go through rough weeks like this one, you know, crazy stuff from Trump, worries about interest rates in Australia and so on, you know, if I get one of those songs in my head, it's a bit like doing meditation, because it drowns out all the negative thoughts. Some people might say it drowns them out too much, but I think it's important to do that. Whereas these days, of course, if you're feeling down and out and you turn on a lot of music, you might find yourself actually feeling more down and out, because the songs have become more despairing or more about heartbreak or more about anger than happy stuff.
Well, there is another way of looking at it. Perhaps Elton John got it right when he said, you know, sad songs say so much, you actually feel a bit better if the song is sad.
Maybe they do, but a lot of Elton John songs are actually quite upbeat, if you think about them. Even I think sad songs have a great melody to it, even though the title for it is kind of sad. But you just think about that Dua Lipa thing he did, Cold Heart, which was just a derivation from other songs. When you listen to it, it sounds really happy sort of stuff with Rocket Man in there. They're kind of happier songs and leave you feeling good, you know, with this nice tune bouncing around in your head. Even though I admit there were some depressing songs from back in that era as well, but they just didn't dominate as much.
Well, Shane, I hope you have a happy weekend. Thanks for joining us on AMP.
You too, Andrew.
Okay, cheers. All right, let's wrap up the market then. Those leaders of today, Life 360 up almost 28% off its upgrade there, certainly with the number of users growing by the minute, it would seem. The gold miners back on the winners list, given it's hit another record too. On the negative side, Drone Shield has come off. Eagers Automotive down at EDI among those losers in today's trade. Among the small caps, quick look at that, energy transition, also some of those gold and critical minerals companies there as well, whereas on the negative side, that's a little mixed. In fact, Cooler Gold's on that list as well as Vinyl and Cyprian Metals. Okay, let's take a look at what's going on overnight. We do get some further detail on those global PMIs and a consumer sentiment index out of the States. And next week, well, it is Australia Day on Monday, so don't forget, we're not going to be here. I assume you have the day off too. If you do, hope you have a great long weekend. We get inflation data. That's going to be key. We just spoke about that with Shane Oliver ahead of the RBA's next meeting, plus the Fed's policy decision too. Big week in that regard, and some key earnings too. Look at those names there, among them Microsoft, Meta, Tesla and Apple. And we're just almost approaching our own earnings season here, getting some of that further detail of those quarterly reports out of the resource miners as well. All right, now this is where we're finishing marginally higher on the CBO 200 and looks on the ASX 200 as though we're going to finish the week around 0.5% higher. That is the show, it's the day and the week. Thanks for watching and listening.